Good afternoon, everyone, and thank you for joining us. I am Eric Eady, Chief Operating Officer of CFA Society San Francisco. It is my pleasure to welcome you to our event, After the Boom, What China's Slowing Economy Means for Global Markets. Our global speakers today are Gerard DePipo, Trin Nguyen, and Dr. Zoe Liu, CFA. A quick item of note before we start. You will be muted for the event, so we encourage you to type your questions for our speakers into the Q&A box below. We will monitor the questions closely and endeavor to have as many answered as possible. This event is being recorded and a replay will be shared. Now I'd like to introduce our moderator, Nick Borst, CFA. Nick is the Vice President and Director of China Research for Seafarer Capital Partners. Prior to joining Seafarer, he was a senior analyst at the Federal Reserve Bank of San Francisco, covering financial and economic developments in Greater China. His research and commentary have been featured in the Financial Times, the Wall Street Journal, the Economist, Bloomberg, and South China Morning Post. He is a member of the National Committee on U.S.-China Relations and has testified before the U.S.-China Economic and Security Review Commissions on multiple occasions. Nick, thank you, and please proceed with the program.
Well, thank you for that welcome, Eric, and thank you to CFA San Francisco for hosting this event. This is really a perfect time to have a conversation about China. It's no exaggeration to say that, negative headlines about the Chinese economy have dominated a lot of the news recently. There are major ongoing problems in China's real estate market. Evergrande, which was formerly one of China's largest property developers, is entering a very messy bankruptcy. And there are several other Chinese developers who are at similar risk of failure. Last year, there was premature talk about a reopening boom in China after COVID-0 policies were ended. Instead, China's economic recovery has been quite disappointing, and there's signs that the economy actually lost momentum over the course of the year. China's domestic stock market has been volatile, and we've seen a sharp drop in prices over the past couple of months. And in response to this market slide, the Chinese government has imposed restrictions on investors to prevent selling, fired the chief securities regulator, and mobilized state funds to support prices. And finally, as if that wasn't enough, China is facing the threat of increasing trade tensions with the United States and many of its large trading partners. So in these moments when so much is occurring, I think it's really helpful to take a step back and look at the big picture. Compared to the narrative of just a few years ago, that of China as a rising economic superpower, China now seems to be on a very different economic trajectory. And while we hope China's economy stabilizes this year, it's unlikely to return to the rapid growth of the past. Today, we're going to discuss many of the deep and structural economic challenges that Beijing must grapple with. As the Chinese economy slows, its impact on the rest of the world will likely change. So how do we understand what's going on in China, where the country is headed, and how it will impact the rest of the world? We're lucky today to have a panel of three amazing economists, each of whom has followed China closely for many years and has thoughtful and insightful comments to share with our group today. Just a note on the programming structure. We're going to have a panel discussion of around 45 minutes or so, and then we'll open it up to Q&A from the audience. But as Eric noted, you can submit your questions anytime as we're talking in the Q&A box, and we'll try to get to as many as we can. I'd like to first introduce Gerard DePipo. Gerard is the Senior Geoeconomics Analyst for Bloomberg Economics. Prior to joining Bloomberg, he was a Senior Fellow at CSIS, the Center for Strategic and International Studies. And before that, he spent 11 years in the U.S. intelligence community. Trin Nguyen is a senior economist covering emerging Asia at Natixis. She's based in Hong Kong. Trin, thank you for joining us early this morning. Prior to Natixis, Trin worked at HSBC as an Asia economist. She also worked at the World Bank as a consultant, where she did research on foreign direct investment and labor market trends. And finally, Dr. Zoe Liu is the Maurice Greenberg Fellow for China Studies at the Council on Foreign Relations. Her work focuses on international finance, sovereign wealth funds, industrial policies, and the geoeconomics of energy transition. She's the author of a great new book, Sovereign Funds, How the Communist Party of China Finances Its Global Ambitions. Zoe is also an adjunct professor at Columbia University and a columnist for Foreign Policy magazine. So thank you all for joining us today for this very timely discussion on China. Zoe, I'd like to begin by asking you a question. I think you've done a great job setting out a framework for how to think about what's going on in the Chinese economy. You've coined them the 4Ds: debt, demand, demographics, and decoupling. So can you walk us through each of these factors and how they're impacting China right now?
Thank you very much, Nick, for your kind introduction. And before I answer your questions, I'd like to extend my sincere thank you to the CFA San Francisco chapter and also to all the participants here. It's interesting that you raised the 4Ds because I first talked about the 4Ds in the it was during the summer 2022, and I was thinking through all the craziness about zero COVID, and then at that time people already started to talk about the what if question: if China exit the zero COVID policy, and perhaps there will be revenge consumer spending, and the Chinese economy would be roaring back. Then eventually I end up thinking that probably that there is a strong argument to say probably no. So I was trying to figure out what would be a succinct framework to explain the sort of structural or cyclical factors. I ended up with the 4Ds: that demand, demographics, and decoupling. And the reason that I say they are both cyclical and structural is because a lot of these factors, in particular the structural element, can be and have been exacerbated by not just the economic cycles, both within China and in the global market, but also the policy cycles, especially the growing policy uncertainties since President Xi Jinping came to power, especially during his second term. So, I'll begin by quickly saying that the first D, debt. Probably the three big that is problematic. That is not necessarily a problem on its own, but when debt becomes unsustainable, meaning the growth of debt is faster than profit and GDP growth, it becomes a problem. And in China, it is particularly a problem for three categories of groups, including the local governments, especially those that are less developed, and private property developers who have long relied upon borrowing and unconventional financing at a much higher cost than the state-owned property developers. And then the third one, but not least, is the household, especially those whose household assets have deteriorated, part of a very significant reason was because of the property sector slowdown and house value deterioration. And Nick, you've done a lot of great work on the household balance sheet, and your work actually speaks a lot to this aspect. Now, a lot of these debt problems get aggregated and have a lot of the suppressing factor to China's domestic demand, and in particular household sector. Now, when people say, and the latest number shows that like Chinese the ultimate the contribution to China GDP growth in terms of final consumption is actually pretty high as higher than 80%. But the kind of ultimate consumption include not just household consumption, but also investment, right? So from that perspective, if we only look at household consumption, China is still very much under-consumed. If OECD average or global average is about 60% of consumption as GDP growth, whereas China was barely 38%. So from that perspective, a lot of this debt problem would further contract household consumption. And then if we think about demand from the export perspective, export has actually shrunk. China's export as a percentage of GDP have sort of have peaked around 2006. That was about 36% of GDP, whereas since then has declined and relatively stabilized around 20%. And the latest data showed that export further contracted. And the other factor in terms of decoupling exacerbate export a lot furthermore. And then finally, in terms of demographics, this is another structural factor constraining the Chinese economy because of the one China policy. And it's a problem not just for sort of chipping away China's labor premium, cheap higher educated labor, but also it's a cost for social security and welfare expenditure. A lot of estimations saying that by 2040, China is going to have somewhere around higher than 400 million people, which is about 28% of the Chinese population. And by that same year, the entire U.S. population, the entirety of U.S. population would be around 380 million, meaning by that time, like literally within the next 6 years, China's old people, meaning older than 60 years, is going to be more than the entirety of U.S. population. So that is going to create a lot of burden for China's social welfare expenditure. And the CAS, China's Social Science Academy, already forecasted that are probably around 2035, 2036, China's the social security fund is going to run out of money. So a lot of these 4D factors, they are structural baked in, but cyclical factors, in particular the policy cycle, exacerbated them.
Well, great. Thank you for that explanation. So if it's a mix of structural and cyclical factors, what's your assessment of, policymakers sitting in Beijing? How much agreement would they have with the list you just set forth? And how would you evaluate, are they adopting the right policies to where they can? Obviously, some structural factors are quite hard to overcome, but how would you evaluate, give a grade to China's response to these 4Ds?
I think, Nick, you are right that I think you and I probably would agree that it's not that the policymakers or Chinese economists have no idea of the problems, but the challenge is the existing economic growth model is led by export growth, prioritized state-led investment. This is made possible because of financial repression that has basically been perfected since Deng Xiaoping's start of reform and open up, featuring relatively low real deposit rate and capital controls and things like that. So in the past 3 decades, basically this system has been perfected. Therefore, it created a lot of invested interest, making the reform very difficult. And on top of that, I think the latest central finance Central Finance Work Conference in October, and the latest Central Economic Work Conference in December, both emphasized they have similar wording on one thing, which is preventing systematic risk, and they identify the real estate sector and the local government debt, and then the last one is small and medium-sized bank failure. So from that perspective, I think the Chinese policymakers are very focused, trying to prevent systematic risk, not just because of the property market, but trying to contain property slowdown to spread across the entire supply chain of housing-related issues. Now, are they concerned about a big systematic bank failure? I think they are not. They specifically said that they do not see the risk of a systematic failure. And I think I would agree with their assessment, specifically because state-owned commercial banks, especially the big ones, on the one hand, there was already they already had a problem before, back in early 2000s, and the playbook was to have a central Beijing bail them out. So there is established the playbook to prevent that. And then on top of that, state-owned commercial banks, the big ones, are not necessarily so heavily exposed to these troubled property developers. So the narrowly targeted is the housing-related sectors, as well as those who are more exposed to the troubled private property developers. I think this is actually not a bad thing if they were able, as the Chinese planners, policymakers, if policies can be implemented through the so-called precision-guided monetary tools, trying to meet the so-called reasonable financing need, probably this is not necessarily a bad moment in China's property market, because it was the entire business model was based upon highly leveraged rapid expansion that is eventually going to be, not sustainable anyways.
Yeah, narrowing in on the property market, I've heard the argument trotted out there, and love to get your reaction, and also Gerard and Trent, if you want to chime in. A lot of people are saying this is really about the property market. If there's a counterfactual where China, doesn't implement the 3 red lines and doesn't do this wide-ranging property crackdown in 2020, the overall economic position would look much, much different. So is it really tied up just with the property market, or there's deeper issues that, regardless of what policies we're taking with the property market, we'd be talking about, the Chinese economy that we are today?
I take the first stab, and Gerard and Tring chime in, and also Nick. So just to put everybody on the same level playing field, the 3 red lines, it's not that the central government to say this is the 3 red lines, is the medium dubbed it as the 3 red lines. It sort of refers to a set of policies implemented by Chinese regulators around the summer of 2020. And the 3 red lines, meaning basically it means putting a cap on the property developers' debt ratio, meaning debt to cash, debt to asset, and debt to equity ratio. So because targeting that, it becomes problematic for the private property developers when their entire business model was on. They focus on debt-fueled expansion, expand rapidly, whereas their profit has been extremely low. Now, is this for? I really disagree with the timing of the policy implemented at that time, but I do think that a policy curbing excessive borrowing and trying to tame the rapid price increase in China, like the property price boom, that is hugely politically popular among Chinese people. So from that perspective, I think it is about curbing excess borrowing, but probably there is also a political concern. I mean, think about this. The PBOC's policy guideline, most important job of the PBOC is price stability. So price is very important. It's not just economic, it's also politically sensitive.
I would have said before COVID that the most important sector in the Chinese economy is property by far, right? So before COVID, it peaked something like 25% of GDP for factoring all the related inputs and outputs. Our China team at Bloomberg Economics estimates that they're basically 2/3 of the way through the correction they'll need to do in terms of getting, sorry if my cat's meowing, getting the construction down to a sustainable level relative to demand. But the process was probably inevitable. Maybe the analogy is that you needed, it was basically, there was a lot of fuel, and 3 red lines was arguably the match. Maybe there would have been a match eventually, but it was a decision. They did it at a time, as Zoe was saying, that it was inopportune. I mean, maybe there was some defense of the timing, but it really was during COVID, and they really didn't have many other stools to stand on except for exports at the time. In terms of it seems pretty clear to me that the diminished sentiment, particularly amongst households in China, is largely tied to property. So property, yes, it might be the case that reducing the inflation, so to speak, of property prices is popular, but deflating it, which seems to be happening more so than NBS stats will suggest, is basically deflating everyone's savings. I mean, the reality in China is that you have very high savings rates. The money is not supposed to really be able to leave internationally. The stock market has not been profitable. It's having a terrible last 12 months, but even before then, it was never that profitable. And the bond market's not that lucrative. So basically, the property sector was the main savings vehicle, and the government is deflating that. So in essence, you're taking several years of marginal savings of households and saying that didn't happen. So of course, there's no revenge spending. And then on top of that, as Nick, you've written, like this is linked intrinsically very much so to local government finance sustainability. And it seems to me that Beijing really had no plan for where this would go. And it was foreseeable that it would affect all major segments of the fiscal system and construction and related inputs and outputs and sentiment. But there's not really a clear end goal or end state. And the central government does not want to be the one holding the bag. They really don't want to bail out property developers. They don't want to bail out localities. There are obvious moral hazard reasons for that. But I think until they have some clear plan that's credible and sustainable, they're going to be in this sort of decline that maybe will stabilize hopefully over the next year or so. But it will be stabilizing at a lower level with essentially a lot of paper wealth evaporated.
Yeah, maybe the right policy at the wrong time and without a lot of thought to the follow-on consequences that would ripple out through the rest of the economy. Trin, I wanted to ask you, China has been an engine of growth for many emerging markets and Asian economies, or at least that's been the perception. Now that things are slowing and the trajectory of the economy has changed, do you see, adjustments to trade and investment patterns as a result of this, or is it still too early?
Thank you very much for having me. First, I think I just want to zoom out on China and how it relates to the region. So in context of the 4Ds, right? So first, China is a very important import market. It's the second largest in the world. And obviously, if you look at China trade balance, then it has a surplus, which means if you look at Asia, most of the country has a trade deficit with China, but as an import market, it is still very important. So China imports in recent years haven't been great. Since the 2018 big import fair in Shanghai that was supposed to make China become #1 import in the world, this demand model never materialized. And as a result, in recent years, China has been a huge drag. Now, what does that mean for the rest of the region? The impact is different, depends on where you're on the supply chain. For Indonesia, the property bust is not so great, but then you have geopolitics pushing up commodity prices. So there's a bit of an offset. China relationships to the region comes from its imports of intermediates and its imports for consumption. Within Asia, imports for consumption comes in two categories. One is durable goods, which have been very sensitive to economic cycles, and other inelastic goods like food, etc. That remains very inelastic. So when you see the decline of cyclical demand, you see it impacting more countries are more cyclicals in general. When you see a structural decline of demand, that will impact overall. Now, China effort to decouple and in relationship, the rest of the world try to decouple from China. The Made in 2025 is seen to be very, very problematic for a few countries in general. One is Korea. Two, of course, the big high-tech countries that compete with China directly. Korea no longer has a trade surplus with China, and that's highly problematic for Korea. So in relation to China trying to move up the value chain, as you know, China, instead of pivoting from this supply-driven growth to demand-driven growth, it never did that, right? So that 2018 fair was like a false hope for the rest of the world. And actually, it was a warning, as we know, that after that, we have a lot happening from trade war and so on and so forth, and of course, COVID. Now, as a result of that, you have a huge reshuffling of region in response to this recoupling due to geopolitics. And I think that that is a key trend to watch in the region. One example is that we start reactions from the rest of the world in response to China decoupling needs with industrial policies in the US, with industrial policies in Korea, industrial policies increasingly in Europe. Now that is it going to be matched with China desire to get out of this demand trap, right? The recent trends from China is that deflation is ongoing very strong. Now, with ongoing strong deflation, Chinese enterprises and people are very innovative. They would try to export that out to the rest of the world. And there is policy of support, even with profits declining, policy support for certain sectors is very, very high. So the implication for this is that we have two prongs, right? One is that the rest of the Asia region can benefit from this decoupling policies like South Korea being export more to the US because it has an FTA, it has incentives. But at the same time, the Koreans are facing more policy impetus to even do more industrial policies because they have over time not just not being able to export to China, but also have to import more Chinese intermediate goods. So that's a huge stretch. So how do I see this playing out in terms of trade investment policies across the region? We see countries that have more complementary pictures to China benefiting more. So if we're talking about the 4Ds, debt, demographic, deflation, and decoupling, India comes to mind as a mirror image, right? China debt to GDP ratio is 288%. One of the ways you deleverage is you lower nominal interest rates or you raise nominal GDP. And China's not able to do that. So even if interest rates in China are very low, real rates are too high. So the leverage ratios continue to increase. It rose very rapidly after COVID. Now, the actual interesting about India economic cycle relative to China is that it actually deleveraged. As the world binged on this China bull story up until 2018 when everything started to hit at once, India was not a favorite for investors. It's not seen, not a sexy story at all. But actually, because of this, it's actually one of the positives of India is that corporates have deleveraged, and most of the debt that people talk about is on the government balance sheet. So I think that India is benefiting. If you talk about the 4Ds, it's a complete mirror image of China in every way. It benefits. It does not compete with China on the trade front because India is a service export sector. It's not a manufacturing prowess. It wants to attract more, so the base is very low. So I would think about in that way of relationships, and the relationship a bit more mixed pictures for some countries like South Korea, where you have both the benefits of being such a nimble, highly cyclical economy and high tech. You are gaining some, but at the same time, you continue to see stress, right? So it's a more of a mixed bag, and also it has a very similar picture to China as well in this 3Ds. And the only difference between Korea and I would say China is that the decoupling, the geopolitical stress is not really there. In fact, it's getting a positive because of assumptions with the US. And the second factor is that China policymakers in Korea are much more responsive to what's happening, right? And it's a very different picture than China because it's a small economy. It has to export to the rest of the world, and it has its issues. So as a result, we think that the outlook for Korea versus China in terms of financial markets would be different, and the different companies, because it will not allow for what has happened to China, which is basically a definancialization of the economy, right? If India is financializing, leveraging, and so on and so forth, the opposite is happening on the financial sector. Not necessarily on the debt to GDP ratio, but definitely on the financial sector side. As the market cap shrinks to it was almost 100% of GDP, and now it's almost half of that, right?
Thanks, Rin. That's really interesting. And anyone else, please feel free to jump in on this. But I'm really intrigued by this concept you lay out of decoupling demand that will help offset some of the structural decline in Chinese demand. But at the same time, China has these huge surpluses that it's seeking to potentially unload on the rest of the world and exacerbate some of these trade imbalances. And India has been held out as sort of the hope, to replace the offset in Chinese demand. How realistic is that, do you think? I mean, obviously the Indian economy is still quite a bit smaller than China. Can India or really any other country replicate what China did over the past 2 decades, or was it very kind of unique and circumstance specific to China?
Well, I think this question is always very nuanced. And so we get two kinds of people that walk into my desk say, India cannot be China. Take manufacturing. That's very simple, right? So manufacturing is an easy one to be down on India because India manufacturing export is less than Vietnam, right? So Vietnam is a very, very, very small country, mind you. So there's a lot of room for India to grow. So even if India is just to go, I give you an example of energy consumption per capita. It's even if for it to just grow to Vietnam's level, it would double what it is today, right? Because it's just so massive in size in terms of energy demand. If you talk about exports in terms of industrial powerhouse, they do have policy, but it takes a lot of time. India is a very different country than China, right? There's less centralization. So it's harder to kind of push through a lot of reforms in terms of manufacturing and being able to build these massive infrastructure, which is happening. But in certain sectors is already going there. So for example, in oil, it's already the third largest in the world. So in the future, people expect that to grow further, right? In terms of demand, India imports a lot of these countries in net aggregate demand importer. It just depends on what sector you segment and you look at. If you look from a point of view LVMH, will it replace China in the next decade or so? Maybe not, but the growth is certainly there because it's just on a lower base. So I would look at it more of a sectoral basis on a very nuanced point of view. And just because China is down because of the 4Ds doesn't mean there aren't opportunities for it to grow in the future, right? Aging related, and even on the luxury segment, it continues to be quite punching because it managed to create this middle class. So India doesn't have that, and it needs to create that. So generally speaking, it really depends on how you look at this. But I would say the floor is very, the base is very low for India to grow. So I think it's very hard for it to disappoint on the growth front, right? And so as a result, it will be able to continue to have that strong growth trajectory. And I would say a second thing I would be positive of India is that it's industrializing or trying to industrialize while China is slowing down, which is very positive in that it doesn't have to compete with China for commodities. Commodity prices have taken a bit of a beating, and as a result, it will be able to do that. But I would not make that comparison across all sectors for between India and China. And I don't think that India will be China, and I don't think that will be the play. The play is that we're going to be more diversified. So instead of looking at Asia as a China play only, which is what a lot of investors do, because it's so big and it's so overwhelming, I think it's going to be Asia with different markets have different segments of the supply chain. Different markets have different attractive consumption patterns and so on and so forth, right? Japan, Korea for high tech, so on and so forth. And even people thinking about headquarters in Asia, it's not going to be Hong Kong or Singapore. It's going to be we have more regionalization and diversification. And I think for investors, that would be the same. Instead of just going from all in from China to India, we're going to be more diversified, right? We're talking about global markets, diversification of equities or bonds and so on and so forth. We are going to be much more diversified and allocate across the region. And I think that will be the play, not just for short-term tactical reallocation, but long-term supply chains, because that is the lesson from COVID. We have too much concentration risk from COVID, we realized that China, while it may hold 20%, a little bit more than 20% global market share of manufacturing, it has total market share in certain items, right? And as a result, that's a big, big risk because, as you know, they translate to what if China shuts down? Oh, actually, that happened. What if we have policy risk? Oh, actually, that happened, right? So all these, when you flip to the end of presentation, the risk section, all of that materialize. So then you have to revisit that totally, right? So I think that is the implication for the region. So I would never say moving out of China, going entirely into, and it does not have that absorptive capacity, right? Valuations are quite stretched already, and the Indian government is very wary of it. Any emerging market should be wary of global capital hunting for profits because you are so small, you can be totally overwhelmed, right? Very quickly, and it's a huge political instability, and capital allocation can be very inefficient in the short term if you have too much capital chasing you at the same time.
Gerard, I wanted to turn to you. You're based in Washington and follow U.S.-China relationship very closely. There were many news stories earlier this month kind of noting that, for the first time in more than 2 decades, Mexico had actually surpassed China as the chief source of imports into the U.S. People were sort of pointing it out as a watershed moment of this decoupling that we've all been talking about for a while. So I wonder, can you give us your sense of how much economic decoupling between the U.S. and China has actually occurred?
Sure. So break it down by type of interaction. People will talk of goods trade as being probably the most obvious in part because it's the one you can quantify. I think some people will say, well, trade is X trillion dollars, therefore they're not decoupling, but I think you have to look at it in terms of trade shares or relative to GDP. Total bilateral trade relative to the economies of the US and China is actually down relative to GDP. You're right that US data, so from the Census Bureau, shows that Mexico overtook last year China for imports into the US market. There are a few caveats there. One is that a lot of those goods from ASEAN and Mexico in particular are going to have Chinese components. There's also some of those firms, this is much more true in ASEAN than it is in Mexico, are Chinese firms or Chinese invested firms. So you can see this in the OECD data where the Chinese share of manufacturing in ASEAN countries by ownership is actually higher than other countries. And then there's also the transshipment issue, right? So the traditional linkage between US reported import data from China and China's export data to the US has broken down. It used to be that US data was higher because it was reflecting the shipping and insurance costs. That is reversed. So now that China is in essence reporting higher exports to the US and the US is importing, but according to US data, and we think a lot of that is due to transshipment. So it's a bit misleading, but yes, people cited that. If you look at services, that's definitely down. A lot of that was because of COVID. It's largely education and travel, and that's down for obvious reasons. It's recovering a little bit, but it's definitely much lower than it was before COVID. In terms of portfolio investment, yes, that's definitely down, but it's, kind of everyone is pulling out of China to some degree. And on the FDI side, Chinese FDI in the US pretty much dried up after FIRMA in 2018 because they were more or less told you're not welcome. US FDI into China is down as well, as is true from FDI from a lot of other countries into China. When you get into softer stuff that's hard to quantify, like people-to-people ties or like academic research, that is fraying to some degree. Part of that is political. Part of that is, I think, downstream of the fact that it's just harder to travel and in both directions, at least compared to what it was before COVID. But I think, there are some will say China and the US cannot be decoupled. I don't think that is correct, in part because some of what the shifts you're seeing, like production obviously moving to, say, Vietnam, and yes, a lot of the Vietnamese exports will have Chinese components, but this is what development looks like, right? You sort of climb the ladder. China did the same thing. You sort of start with final assembly and you move down the value chain or up the value chain, depending on which direction. So the process takes time, but there is some degree of decoupling. I think it's just, you need to think of it as like a 5 to 10 year process and not one that you're going to see with, a single data point from any given year.
Yeah, I agree.
Can I add to this too?
Yeah.
Okay, so I would say the push for Chinese firms to diversify risk is very high. right? So we talk a lot about Western firms diversifying, or the North Asian firms, and so on and so forth. China outward FDI is blocked pretty much to US, a lot of Western countries, because there's a lot of scrutiny. Where are they welcome? They're welcome in neutral countries, right? So ASEAN is a good example. And then ASEAN is basically, you can diversify two things when you're there. One is you diversify geopolitical risk, where there's tariffs or increased scrutiny of Chinese goods. The second thing is demand, right? A lot of ASEAN countries have very favorable demographics and low debt. So if you do a debt chart in Asia, the lowest ones are like India and ASEAN, right? Lowest would be ASEAN. So not all the ASEAN countries are very, very perfect, but in many ways, you can say that the reshuffling of the supply chain and investment and so on and so forth isn't just a Western point of view. It's also Chinese companies need to also diversify their own risks, and no one has more concentration risk on China than Chinese firms, right? Because they're basically being targeted geopolitically, and then also you have political forces being to reshuffle capital, only wanting to reallocate it to manufacturing and higher end manufacturing. So everyone chases the same thing in China, where profit margins are squeezed, where if you exit that, you can have less competition and you can diversify risk. So that is happening. And I think while some people dismiss that, just because if you look at the trends of there are some couple of stories, if you read Bloomberg pre-COVID, pre-Trump, right? China is, there's a disconnect between financial markets, which is US dollar, and relationships of the US with the rest of the region, because that has declined, China has gone up, and so on and so forth. That's the story. The story actually has become more nuanced. We still have people beating the drums on why the dollar is so, the French like to call it exorbitant privilege, and so on and so forth. But actually, the relationship with the US has increased across the region in terms of exports, as a share of total. And the only country where that doesn't happen is Indonesia, right? In fact, for Vietnam, it's been crazy, Korea, and so on and so forth. And I think that trend will continue to increase. So actually, that has huge consequences also in real, the reshuffling of investment has consequences in real exports over time. And I think that's a question for Indonesia too. And we have a new president elected, or we'll see if active polls. But the fact that China has gone to Indonesia, and the fact that it has this huge dependency on China over time, what will it do to capture this trend that's happening in the world, to diversify not just export destination, but also in terms of commodities that are export to China, because that's the trend. We need to diversify investment, and that has a material impact. And of course, that has a material impact in terms of capital allocation and also employment, right? Headcount demand is important to a lot of these countries, because in Asia, we still have a lot of people. And in China, even if it's demographic doom scenario, we have a huge unemployment problem in youth unemployment, right? So that's something that's quite important.
This idea of decoupling being a long-term process, I think, is quite interesting. And we had the Trump administration come in, start the trade war, launch all these technological restrictions. In contrast to what many people might have thought, the Biden administration essentially kept all of the Trump administration policies in some aspects, tightened them up even further. So Gerard and anyone else who wants to weigh in on this, we're 9 months away from a presidential election. It seems obvious that China is yet again going to be a major topic. What's at stake specifically right now for the U.S.-China economic relationship with the presidential election?
I think the Biden administration is tonally different in how they approach China, but the substance is not all that different, but it is somewhat different. So with the Trump administration, I would actually bracket it into two periods. One is basically before COVID, which is more or less the trade war, where the U.S. was doing some things. Most aggressive besides the tariffs would have been the actions against Huawei. The ZTE actions were somewhat walked back by Trump. That was because Trump really just cared about the trade war and the trade balance. Once the phase one deal was reached, which did not actually end it was more of a truce, right? Didn't actually end the trade war because the tariffs are still in place. But China agreed to certain import targets, which they later fell well short of. Once COVID happened, Trump blamed China for that, fairly or not, and more or less unleashed much of the bureaucracy. So a lot of things that people had wanted to do that had been blocked by Trump, who was actually not all that hawkish on China itself, He just cares about trade. That was no longer stopped, I think, because he was angry. And I saw this, I was in government at the time. And in fact, we published a what's called a big take. So I think it was last Monday on the Bloomberg website talking about Trump versus Biden on China. And we actually quantified the number of SDN sanctions and entity listings of Chinese entities that the US did. And with the Trump administration, what you see is the number spiked a lot in 2020. And then for the Biden administration, it's been fairly steady, although it did jump in 2023, which is somewhat interesting in that this is the year of sort of tactical, or last year rather was the year of tactical stabilization. So I think if Biden or the Dems, Biden's probably the candidate. I'm not certain about that. We'll see. If they win, it will probably look more or less like it does now. There'll be more measures. There are measures still in the quiver. So probably within a week, the administration will announce an executive order on data privacy that is more or less intended to block the sale of bulk data of various kinds, including medical and financial, to China. That's basically what it's about. And there are probably maybe some more export controls coming, but I think BIS at Commerce is basically overwhelmed. So a year ago, you would have seen Estevez, ahead of the BIS at Commerce, talking about wanting to do more export controls, and they haven't actually done them. And just because bureaucratically they're overwhelmed and they don't have the staffing to do it, but they're working on that. But if Trump wins, and I do think Trump will be the candidate, there's a lot of variance because it depends which Trump we're getting. So if we're getting Trump circa 2018, looking to make some type of trade deal with China, it will be competing impulses. In any administration, you would say personnel is policy, but that's especially true in the Trump administration. I think is really because Trump just doesn't care about a lot of details of policy and doesn't try to coordinate, with the exception of trade. And so it really depends who's in the administration and what they can get away with. He definitely blocked a lot of hawkish actions that some in his administration wanted to do. But if he's in 2020 mode, Trump, then there's more of a maximalist version of that that would be much more aggressive. And there were other actions that were considered in 2020 that didn't happen, but if they had happened, would have been a pretty big deal. And those things could happen. So we'll see. But I think basically neither will be going easy on China. But I think under a Trump administration, there's potential for sort of more downside risk.
Yeah, that's really interesting because it appears we're basically have a ratchet-like effect with U.S.-China economic policy where things only get tighter over time. If I heard you right, Gerard, you're sort of saying yes, that's the expectation, but on the off chance that the U.S. actually returns to wanting things from China, asking China for things in terms of trade deals and maybe other deliverables, are there scenarios you or anyone else sees where things could actually go on a more optimistic path and we might see a little bit of relaxation, or should we sort of expect that going forward it's basically the status quo in terms of U.S.-China economic tensions?
I think it's only plausible under Trump administration if Trump wanted to make a particular transaction.
Yeah.
If I can quickly just chime in here, I think it's also, I will adopt what trends, the approach that the trend take. It's probably sectoralized. And in particular, there are perhaps a priority regardless of which administration, which is the fentanyl issue. And that is an area where the United States and China would have to work together. And the fact that China finding itself trapped in America's fentanyl crisis was not because of there is this Chinese sort of opium war strategy trying to poison the American mind, but in fact, there are a lot of government industrial policies, both at the central government level and at the local government level, prioritizing the development of the pharmaceutical and the petrochemical industry, which triggered a lot of this small chemical makers and API makers, right? So perhaps in order for the two countries to really address the fentanyl issue, the two countries would have to work together in terms of addressing the overcapacity in the not just the petrochemical, but also this small pharmaceutical manufacturing sector. And then the other area that the two countries would see relationship stabilization or even warming up, but compartmentalized, would be related to climate change related issues, and in particular on trying to negotiate certain types of deals with regard to climate fund, but that also very intricately related to the Inflation Reduction Act and so on and so forth, as well as the smart grid or the use of chips in a lot of this new climate or new renewable energy sector. So so climate is another area where the two countries could work together, but again, it would be another compartmentalized area. And then finally, the other area that is the two countries would the relationship warming up probably in food security, and that's also another area where both it works for certain constituencies here in the United States, but it's also a priority for the Chinese government, in particular under Xi Jinping administration, the emphasis on food security.
Well, we're have about 10 minutes left in the event, and I know we could go on in these topics for a long time, but I want to make sure we get to some of the audience questions. I'm going to try to summarize a few questions into one question, just in the interest of efficiency. So several questions sort of around what does China have to do to get its economy back on its feet? What does it have to do to get Chinese consumers spending again, confident again? Is China open to the same kind of stimulus and consumption-oriented stimulus that we've seen in the US and other countries? Is that realistic? Is that a path that any of you could see China taking in order to restart the economy?
Should I go quickly?
Sure, go, Trent.
Okay, I'll do since I'm more of a short-term person, given that I spend a lot of days just looking at the markets. I would say two things. Very easily is a lot of this problem is self-imposed, right? So I would say that they can reverse it. One, and then some are harder to reverse. So one, I would say on the interest rate side, it's very hard when you have the dollar going higher to cut rates very aggressively. So right, so one of the ways that you can reduce the high real interest rate environment that's facing, which is basically it's deflated, right? So when you have consumption deflated and supply just continue to grow, you have a challenge. And firms like inflation. So you need to be able to cut interest rates, and China at the moment cannot. So the Fed kind of just cut rates, hopefully, whenever that happens, that would put less pressure on China to be able to do that. The second one is on the demand side, whether or not China wants to do the consumption related stimulus. President Xi Jinping doesn't really like this, right? He doesn't like making people weak by giving away things, and so on and so forth. So that's highly more challenging. I would say that you can see more likelihood of fiscal stimulus, more support from the central government side. One of the things that China can do, which people will look out for, is to take on more on the central balance sheets, right? The U.S. is very different in that post GFC, the U.S. government absorbed a lot of the toxic assets, and since the central government can borrow much cheaper than local governments and of course households, and you can actually over time delever. So I think it's more likely you have more support on the monetary side if there's room to do so, if the yuan has less pressure. Over longer term solutions for China, there are many major problems in terms of when you have an aging population, and Korea has one. So I would speak about how we can solve this. Is that when you take on central government debt, it will go on, because as you have an aging society, Social Security, as you know, can only increase over time. It becomes a huge burden. And there are two ways you can fix it. You can raise taxation on the property side. China talks a lot about property tax. You can raise the pension age. The official age for China is very low. But these are very politically sensitive times. So I think over time it will need to have done. So taxation is a reform area where it can have more. Every EM has this problem where it can have more taxes directly, and also property tax is probably the final. Instead of getting taxed local governments from land sales, they can probably need to start thinking about taxing the property itself, and that is a form of redistribution from the extra wealthy to those that have less capital, right? So those are the areas I see on the more immediate and the longer term. And obviously, back to that geopolitical question, President Xi Jinping has been playing a lot nicer in the short term, because if you look, he came to San Francisco, he made statements. So I think the fact that China domestic issues will also cause some less escalation of tensions directly anyway from China's side. And I think domestically too, that the loosening of regulations will become more obvious as we have the slowdown become more acute. So two prongs approach. One is putting out the fire first, and the second is to think about more structural issues, which I think will need to come down the road.
Zoe, you touched upon climate change as a potential area for cooperation, and we had a question from the audience on that. What is the impact of the slowdown on China's own climate goals? There's been talk that maybe China's emissions would peak earlier than people expected. Does that have a change in what we should expect from China in terms of contributing to fighting global warming?
In terms of cutting down CO2 emission, I think right now, China's about 60% of China's end energy consumption comes from coal, and coal also is the primary source of electricity generation in China. So if the Chinese economic slowdown continues, and if the world experience another commodity price increase due to supply side issues or disruption in the logistics, probably we'll see China, at least in the short run, revert back to be more dependent on coal-fired power plant. And on top of that, the 14th five-year plan also just have additional coal-fired power plant being scheduled to be planted. So basically, in terms of on the emission side, that is a problem. But I would say China does not only focus on, cutting down emission. The country, as the government is also very investing heavily on carbon capture and sequestration. So hopefully, the idea is not just focusing on cutting down consumption, but really trying to capture it, before it gets emitted into the atmosphere. Now, if we think about to what extent the economic slowdown might impact China's investment into the energy transition, I do not see, at least in the short term, China already built up a lot of excess capacity, solar panel, and so on and so forth. But if you look at the recent Central Economic Conference work, it emphasized both on the fiscal side and on the monetary side, focusing on promoting, facilitating the green transition. And on top of that, on the 7 areas of the so-called new consumption area, one of those 7 areas that the government want to promote consumption is green sector. So I'm not exactly sure how they define this green sector, but at least that is an area where China focus on both on the supply side and on the demand side.
Well, we're almost out of time, but just to wrap it up, one of the things that is made analyzing China's economy even more difficult is the availability of data. We're seeing restrictions on negative economic coverage in China, which has reduced the ability to hear from local voices. There's statistical series that have been disappearing. I'm wondering if each of you could tell us what are the few key indicators or trends that you're really watching closely over the next 6, 12, 18 months to really get a sense of where China's economy is going. What is most important in your mind to watch? So Trin or Gerard, Zoe, anyone who wanted to start?
Well, I mean, so you're right. They tend to redact or stop publishing or amend series that are not favorable. So I would say look at things that are either difficult to, or they cannot falsify or stop publishing. So trade data is one of them. I think Chinese trade stats are actually pretty accurate for obvious customs reasons. The others would be probably property sector. So not the MBS data is actually kind of dodgy in terms of the price effects. There is a lot of on-the-ground reporting suggesting the price changes in certain cities are much bigger than reported. However, there are private services. So because there's so many private parties involved, it's hard to obscure that. Things like macro data is where it gets more difficult because there really aren't substitutes for that, but those are the things that people tend to dispute. So for me, it's probably, I would look at trade data and 'and- and- 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 and
Trin, what are you watching closely?
Inflation and trade are hard to kind of just say people always question Chinese data, but I would say you should think about China data like this. GDP is supply side driven, right? So people say, well, how can you have 5.2% GDP, but imports were declining? And why is the stock market so weak and so on and so forth? So you have to think of this is a command economy. So then GDP has less of a meaning if you're a demand oriented company. Right. So as a result, if you're a profit driven person, which basically everyone is, but so you would look at CPI, right? That's a very clear indicator what's happening, and it's very hard to CPI and trade are my two favorites. CPI is less lagging than trade, and trade another thing that's really great about trade is that China basically not just for China but for other economies, you should look at China. The release is quite timely. The only country that's more timely is actually Korea, and so when you look at it, you can look at how's Singapore doing, how's Europe doing, different cycles, right? Because it's part of a very, even if we're decoupling and we're transitioning and so on and so forth, supply chains, there's a lot there in Chinese data in terms of trade for global usage, and CPI obviously is very, very important. I think markets react quite strongly to China CPI.
Zoe?
And that also has implications for the rest of the world CPI as well.
I would agree with both Gerard and the Train, but I would also want to, the question that Nick you asked reminded me of the so-called Keqiang index, where he talks of Premier Li Keqiang talking about, if I remember it correctly, railway freight volume and electricity generation volume, and the other one is bank loans, if I remember correctly. But basically, it's an acknowledgement of exactly the question, Nick, you were pointing out, the kind of like inaccurate numbers. So in addition to what Trey and Gerard was talking about, because I really focus on consumer household consumption, two things that I would want to focus on to add on top of Trey and Gerard is the transaction volume and the value, both volume and the value on Chinese digital online shopping platforms, especially during the Double 11 days or those holidays. And then I would also wanted to look out for restaurant consumption, both in terms of consuming in the restaurant in-house versus takeout.
Got it. Well, thank you again all so much. I think we could go on for a lot longer, but we are running out of time. So Eric, I will turn it over to you. Eric, I think you might be on mute.
There we go. Thank you again, everyone, for joining us. This is a really informative webinar. I'd like to thank our experts today, Gerard, Trin, Zoe, and Nick. It's a pleasure having you. And we look forward to seeing everyone again at an upcoming event. Take care. Have a good evening.